Welcome to TaxTron web tutorial video series. Today we are diving into a new rule introduced by CRA, the new residential property flipping rule. If you have ever been curious about how this impacts your taxes, you are at the right place. So let's start. What is the property flipping? Property flipping involves purchasing residential property and reselling the property in a short period of time to realize a profit. This also includes selling the rights to purchase a property before the sale is completed. What are the rules for the reporting profit from the property flipping? The profit from the property flipping is fully taxable as a business income and does not qualify for the 50% capital gain inclusion rate or the principal resident exemptions. The new anti-flipping tax rule means profits made off properties that are sold within the 365 days of owning them will be taxed as a business income under the new rule. Under the new rules, any losses on a flipped property are deemed to be zero and cannot be deducted from other income. There are some exceptions to this rule, including death, divorce, safety issues, illness or disability, relocation due to education or employment, insolvency, and a few others. If you want to learn more about these exceptions, you can directly read it through a CRA website. If the property does not fall under the new deemed rule, for example, if it was owned for at least 365 days or sold due to a life event, profit could still be treated as a capital gain or business income depending on the fact of the case. Now let's see how this works on a TaxTron web platform. Let's start by signing into the TaxTron web software. Head over to the T1 clients. Open an existing tax return. Make sure you can create a new tax return for this client, but I will open an existing tax return. The personal information section under the identification tab should be complete and accurate. After completing the identification tab, move to the income profile tab and go to the profile tab. Answer yes to the question, did you work in 2023? And select the T4. After that, you will land on the step, did you sell share or property? Over here, answer yes to the question, did you sell real estate property? And move next. After moving, you will land on the T4 slip. Here we need to complete the T4 information by entering the following information. $45,600 on box 14. And in box 22, we will enter $4,500 and complete the rest of the T4 as shown in the video. As you can see, now this person owes $1,567.74 to CRA. Click Next. You will land on the Real Estate Property Schedule 3 page. Here you will encounter here you will see two questions. Are you splitting income with someone else? If you are, then say yes. We will say no for this example. Is this transaction reported in a foreign currency? If yes, then you can select yes. But for our example, I'll say no. In the next row, you will need to answer some of the miscellaneous information related to the property, such as date of acquired, property number. I'll enter any. Description. Now, assume this person sold the house for $182,000. So we'll enter here. After entering, we need to enter the adjusted cost base. That is $134,000. After entering the following information, you can see this person have the gain of $48,000. Now let's move on to our first scenario. In this case, the individual qualify for an exception for the residential property flipping rule. We can indicate this exemptions by checking one of these specific conditions. Scroll down to the page and go to the title, Did you flip the real estate property? And answer yes. Then you will have another question, was the disposition due to or in anticipation of any of the life event? Select yes here. And then if you scroll further down, you will see the question, the death of the taxpayer or a related person. We will say yes here as well. As you can see, now the balance owing of this person is $8,468.84. To verify this information, let's print the T1 journal from review and file, download the record keeping document so we can check the detailed breakdown of the information that we have input in the software. After downloading the record keeping, scroll down to the T1 journal, line number 12700. Here you can see 50% of taxable capital gain of 24,000 has been reported. In this scenario, the exception due to the death of the taxpayer or related person result in a real estate transaction being treated as a capital gain with the 50% is being taxable. If you want to see the more details, you can scroll up further down for the Schedule 3. You will see the 2023 taxable capital gain is $24,000 has been reported. You can scroll up further down. You will find the question answered yes if the property was flipped in less than 365 days. And also the question, the death of the taxpayer or related person has also been checked. After this scenario, let's move on to our another scenario where we will see the residential flipping property impacts the tax when the real estate transaction is reported as a business income. To do so, navigate to the income profile, go to the real estate property page and add another instance. Complete this Schedule 3 as we have completed the previous one. Enter the following information as shown in the video. After filling this form, answer yes to the question, did you flip the real estate property? And answer no to the question, was the disposition due to or in anticipation of any life event? This was prompted the software to consider the capital gain on the disposition as a taxable business. Now let's go to the review and file to download the record keeping to check the detailed breakdown of this scenario. After downloading the record keeping, scroll down to the T1 journal, line number 13499. As you can see, the $182,000 has been reported as a business income, not as an capital gain for Schedule 3, and the net income of the person is become $48,000, which was the capital gain of the property. As per the CRA requirement, the software will automatically include a T2125 statement of business and professional activities if your property has considered as a taxable business income. Well, that's all for our today's tutorial. We covered how to report the real estate transaction as either a capital gain or a business income, and how the residential property flipping rule impact each scenario. If you found this tutorial helpful, make sure to press the like button and subscribe to our channel. We'll see you in the next video. Thank you for watching.